Let me tell you a quick story. A new business owner that I was working with thought his tax bill would wipe out his first year's profit. He had spent thousands of dollars on a website, training, and even upgrading his office. But he didn't track or deduct these expenses properly. I was able to step in and make a few simple adjustments for him, like claiming his startup costs correctly, using the home office calculation, and logging every business mile. He went from panicking to saving thousands. That stress relief is powerful, and this is exactly what I want for you. In this video, I'll break down the top 5 LLC write-offs that you can use today. Most new LLC owners think that deductions only start when the business is fully running, but actually some of the valuable savings shows up even before you open your doors. Those early investments that you make to get your business started can give you a much smaller tax bill, but only if you track those expenses from day one. If you miss them, then the money is gone for good and you'll end up paying way more to the IRS in taxes than you should have. There's 2 things that you need to know when starting a business: the difference between startup costs and organizational costs. These are the first deductions out of 5 that we're going to be talking about in this video. Startup costs are the money you spend when preparing to open, like designing a logo, printing a business card, or running your first round of advertising to announce your grand opening. Organizational costs, on the other hand, covers technical setup of your business itself, things like legal paperwork, government filings, or paying an accountant to set up your books. Even though they have different names, the IRS treats them in a different category, which can directly reduce your taxable income. Where many business owners go wrong is assuming that these early costs do not qualify. Some forget to include them because they spend the money before their business officially launched, and others don't realize that there's special rules for the first year deduction. The good news is that you don't have to write off all those expenses slowly. The IRS allows an immediate deduction of $5,000 for startup costs and organizational costs. That number alone as a deduction could save you a lot in taxes. There's an important detail that most people miss. Once your startup cost goes beyond the $5,000 mark, you don't get to deduct the entire extra amount right away. Instead, the costs above the first threshold are divided evenly over a period of 15 years through a process called amortization. Don't let that term scare you. It just means that you have to spread the deduction out, giving yourself a smaller tax break every year for as long as the 15-year period lasts. This way you still reduce your taxes, but in smaller amounts rather than all at once. Here's a quick example of how it works in practice. Imagine you spent $12,000 on startup expenses. The first $5,000 qualifies for an immediate deduction, so you can subtract that right away in your opening year. The remaining $7,000 doesn't disappear. Instead, you divide it out over 15 years, which equals to about $460 that you'll be deducting every year for the next 15 years. While it may not sound huge every year, but it adds up. And when you combine it with immediate deductions, you're looking at meaningful long-term savings. Missing out on that kind of benefit could be the difference between you owing money or keeping the money in the business to reinvest. Now let's move to another write-off that hides in plain sight: the home office deduction. If you use part of your home strictly for business, you may be sitting on a deduction without realizing it. A spare bedroom turned into an office, a section of your living room where you run client calls, or even a small desk in the corner can qualify. The big rule is that the space must be used exclusively for business. In other words, if your kids are using that same area to play video games, then it does not qualify as business use. And calculating the deduction doesn't have to be complicated. Let's say your home is 1,000 square feet and you use 100 of that exclusively for your home office. That means 10% of your home is dedicated to your business. And you can apply that percentage to your rent, your light bill, your water bill, and even your internet bill. For example, if your rent is $2,000, 10% of that would be $200. That becomes deductible every month, adding up to $2,400 a year. And if you add the utilities and the internet, that could be a lot more in saving. When you add the home office deduction to the startup cost and organizational deduction, you're building a powerful foundation. Instead of reaching the end of the year embracing for a big tax bill, you'll be able to do some tax planning so you could save a lot when you file your taxes. The money you save can go back into the business as a reinvestment, such as marketing, inventory, and hiring help. And the saving don't stop here. Next, the third deduction we have is the vehicle deduction. If you use your car for business, you can deduct expenses in 2 main ways: the mileage method and the depreciation method. The mileage method, you can deduct 70 cents for every mile that you drive with the car. The depreciation method, you can deduct the value of your car over time. For example, a $50,000 car depreciated over 5 years, you'd be able to deduct $10,000 every year for 5 years. That's using the straight line depreciation method. But if your car weighs more than 6,000 pounds, you can use the bonus depreciation method. Under section 179, that lets you write off the cost of the whole car in year 1. The fourth deduction is marketing and advertising. No business grows without customers, and attracting customers costs money. Marketing and advertising, whether that's a flyer, online ads, or SEO, are fully deductible business expenses. You do not have to spread these costs over time. You can deduct 100% of marketing expenses the same year that you spent it. The last deduction is becoming an S corp. As your business grows, you may benefit from having your LLC taxed as an S corp. LLC and sole proprietors normally pay 15.3% in self-employment taxes. By switching to an S corp, you can avoid the tax on part of your income. Plus, when you pay yourself a salary, you can deduct payroll taxes. This strategy gives you more control of how your income is taxed and can save you thousands of dollars each year. In order to take advantage of these tax write-offs, you need the proper bookkeeping or expense tracking. Don't wait until tax season and scrambling for receipts, trying to figure out what qualifies and what not. Get a system in place now, such as a spreadsheet or an app. Or you can hire a bookkeeper. My firm, Infinity Tax Assistance, we have bookkeeping available for small business owners. We also do free consultation and give you the first month free. Click the link down below for a free consultation. Like and subscribe, and I'll see you guys in the next video.